Today, more bank tricks to make you poorer. Hello again, it's Martin North from Digital Finance Analytics on this post covering finance and property news with a distinctively Australian flavour. Well, Peter Martin, a visiting fellow at the Crawford School of Public Policy at the ANU, wrote in the conversation, "Whenever interest rates went up in the past, I used to get told it wasn't all bad news. At least it was good for some people, savers, people with money in the bank." I hear a lot less of that these days. If you've got money in the bank, you're now lucky to earn anything at all. 1 in 7 of the deposit dollars held by the Commonwealth Bank, Australia's biggest for deposits, is in a transaction account on which it no longer pays interest. Where interest is paid, it's so tiny compared to what it was that Jim Chalmers, the Treasurer this month, directed the Australian Competition and Consumer Commission to conduct an inquiry using its compulsory information gathering powers. The last time the Commission conducted an inquiry into mortgage rates in 2018, it gained access to nearly 40,000 documents from the big four banks and more than 7,000 from the smaller banks. What the Commission is likely to find is that whereas transaction accounts stopped paying interest some time ago, so-called online accounts offering interest on large deposits were paying very reasonable interest up until about 5 years ago. And he asked, how do I know that that's likely finding? Well, he graphed the Reserve Bank's measure of the average online rate for a $10,000 deposit against the Reserve Bank's cash rate going back to 2010. What the graph shows is that until about 5 years ago, the online rate for big deposits moved in line with the cash rate and, as it happened, almost exactly matched it. When the cash rate was 3%, the online deposit rate was 3%, and so on. But from 2018, the deposit rate fell away, except for the time when both rates were close to zero during the early years of COVID. The rate paid on large deposits has stayed well below the cash rate ever since. That's what the official figures say, but Anna Bligh, Chief Executive of the Australian Banking Association, sees things rather differently. This time last year, the four major banks, no bank was offering more than 0.3% on their savings account, she told the Australian Financial Review this month. Right now, they're all offering at least 4% or more, so that's a massive increase. But the rates Bligh quotes aren't the standard ones. The Commonwealth Bank is indeed paying 4% on its so-called Net Bank Saver account, but the 4% is an introductory rate for new customers only before slipping back to 1.6% after 5 months. The web comparison site Canstar finds the average big bank introductory rate on $10,000 is 3.66%, up from 0.24% before the Reserve Bank put the cash rate up by a total of 3.25 points. But the average rate offered when the introductory bonus wears off has climbed by much less, from 0.05 to just 1.16%. Complexity and suspected collusion actually makes switching very hard, and some of the high-looking interest rates have special conditions. The Commonwealth's Gold Saver account, for example, also offers 4%, but only if you put in more money each month. If you can't, or if you make a withdrawal, the rate plummets to 0.25%. The Australian Competition and Consumer Commission's inquiry is likely to find that the complex nature of the deals makes switching hard, just as does the complex nature of electricity and health insurance deals. That's what it found about the bank's mortgage offering in 2018 too. It found that the opaque nature of the offers inflated the costs of shopping around, including time and effort, and was one of the reasons why 70% of borrowers surveyed by one of the big banks said they signed up after getting just one quote. It said that the big four banks profited from the suppression of incentives to shop around and lacked strong incentives to make prices more transparent. So why have the deposit rates offered by the big four banks dropped away? Well, when it came to mortgages, the ACCC suspected tacit collusion. Its 2018 report referred to a synchronised approach to rates 7 times. And in very recent years, the banks have had less reason to offer high rates. During the first 15 months of COVID, the Reserve Bank made available $188 billion of funding to banks at an extraordinary low rate of 0.25% and 0.1%. And of course, they are still getting massive returns on that very cheap money because the RBA is still paying them at the market rate. This means banks had less need to attract deposits, and in any event, they were overwhelmed with deposits. Elevated savings rates during COVID pushed an extra $300 billion through their doors as worried and locked down households sought out safe places to stash cash. Both of these things are changing. The last of the Reserve Bank's cheap 3-year loans to banks expires mid-next year, and households are stashing less into banks than they used to. When announcing the ACCC inquiry, Treasurer Jim Chalmers called on banks to pass on the interest rate rises to savers as quickly as you pass on the interest rate rises to mortgage holders. Now, it is possible deposit rates might be about to improve, all the more so because the banks will be under scrutiny from the ACCC inquiry, which reports at the end of the year. When announcing the inquiry, the Treasurer invoked fairness. Chalmers called on the banks to pass on the interest rate rises to savers as quickly as you pass on interest rates to mortgage holders. But fairness has actually little to do with it. The banks will pay depositors more only when they need to or when they are pressurised to. Until then, for many of us, deposits will earn next to nothing regardless of where the Reserve Bank rates move. So if you've got a savings account, call your bank, quote the article, and ask them what they're going to do about it. This, of course, is consistent with my recent conversations with Steve from Canstar. I'll put the links below. We've been calling this out for months. It's good to see other people are now catching on, finally. But it's not fair. Once again, the banks are in the driving seat, and that should not be allowed to happen. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.